Hi guys, today's topic is cash secure put. Selling cash secure put is like selling an insurance for a car, where you are being the seller of the put or the insurance company, and the put buyer is the car owner. So if the car get hit, you pay to repair it. If the car didn't get hit, you get to keep the premium. And I'll show you how that apply to our situation. So using a cash secure put, you can generate income or return on any stock. It's a return like a dividend with a small exception that it can tax differently. Selling cash secure put is a strategy that involves selling a put option while simultaneously setting aside the cash to buy the underlying stock if the option is exercised. Selling cash secure put option is a strategy that selling cash secure put options is a strategy that involves selling a put option while simultaneously setting aside the cash to buy the underlying stock if the option gets exercised. The goal here is to buy the stock at a lower price than its current market value. This is achieved by selling a put option at a set price while setting aside money to buy the stock if the option is assigned. The seller, hopefully you, receive a premium at the start of the option, and if the stock doesn't reach the strike price, you keep the premium. If the stock does reach the strike price, you must use the secure fund to buy the stock, but you get to keep the premium. So you get to keep the premium either way, which has big advantages. Let's go through a few live examples. So we are going to start here with Apple. As you can see, Apple price right now is 189.85, almost 190. If we go to trade Apple option and press on it, it will bring up the option page. And from here we can see it has two types, call or put. We are going to go to the put side and we are going to choose sell because we are trying to sell the put, not buying it. So from the third option, you can see on the top, it's here you choose the date. From the third option, you can choose the date for where the option will end. The option contract, I should say, since it's a contract between you, the seller, and somebody else, which is the buyer. So I always recommend when selling an option, to get the best chance getting the result that you want, I would recommend going anywhere from 1 to 3 or 4 months. Compare that to going to a 1 week. It's really like gambling. So selling a put for a week or 2 weeks, you're gambling on the stocks going your way and the direction you want. But any small news could move it either direction. It could be an economy news, not even related to the stock, that push the whole stock market up or down. But when you go to few months, you most likely will get the result that you want as long as you chose the correct stock to play. So in this case, let's go, for example, January 21st. As we said, the price right now is almost 190. If you go and you try to sell an option for 150, and if you went and tried to sell an option for 180, you see you will collect $100. You collect $100, and then by that date, if the stock went to 180 or below, then you will have to buy the stock for 180. But if the stock maintain a price above 180, then that option is expired and you get to keep the money. In this case, it's 1 month, and there is no big events coming up. There is no earning call, for example, which is one of the big reasons that push the stocks up or down depending on the result. If we took a longer time frame to see how it's going to make a big difference, in this case, if we wanted to go to August, which is 3 months, including, of course, the next earning call, in this case, you will see the premium you're collecting are much bigger. So in this case, let's say you want to sell the option for 180 again. In this case, you will collect $3 per share or $300 per contract, as each contract is controlling 100 shares. You can see here the bids and ask. These are the people that are trying to buy the option, and these are the people that are currently offering to sell the option. As you can see, there's always a difference between them, In this case, it's 10 cents, which is acceptable. Probably you can get the mid price, the $3, which means it's only $5 difference between each buying and selling. You can see the mark is $3. The previously closed is $3.01. The high of the day is $3. The lower of the day, it's $2.76. The volume is how many contracts have been exchanged today for this specific option, and it was 1,155, which is a great number. You can only find these results on stocks that get traded a lot, like Apple. You can see the open interest is the total amount of contract that's currently open that haven't been closed, and it's 15,073, which is a great number. The implied volatility is how much the stock are expecting to go up or down, which in this case this consider is relatively low, since Apple doesn't really move a lot in either direction, and that honestly that control the premium. So in this case, because it's low, the premium is relatively low. If we go for another example like Tesla, you will see a big difference in the numbers. I want to show you an example of a put, cash secure put, that I have sold recently and I have closed just a few days ago. So here, the Apple 170 put, if I go down to show you the history, on February 16 of this year, I have sold one put option to buy Apple for 170, and at that time Apple was at $182. So I had a good cushion, and I don't mind owning more Apple, even that I have 500 share of Apple. As you can see, the contract have been filled for $4 per share, which means $400 that I have received in my account. During this period, Apple stock have swung to the upside and downside. Let's take a look. So if we take it to the 3-month, actually it's a great coincidence that I have sold it on February 16, and we can see how it went. Of course, it doesn't show that on February 16 it went up and down, and when I sold it, it was 400 instead of 360. But in either case, as you can see here, it went up. It did not feel good. At this point, it showed me my unrealized return was minus 100%, because I got $400, but if I wanted to buy to close the contract, I will have to pay $800. I don't want to do that. So all I did is wait. I did not have to touch it. I didn't get scared. I had faith in Apple, and it continued, as you can see, going up and down. Like it at this point on March 20, it went down to under my price, but I didn't want to close it because I'm not going to make any profit at this point. It went up again, it went down, it went up. At this point, it did not feel good. I'm not going to lie. It was, I think Apple was 168, so it was in the money. And all the channel news about Apple wasn't positive. It was all super negative. In any case, Apple reported earnings, and it did a big buyback. It's the biggest in the U.S. stock market, $110 billion. The stock price start rallying, and with that, the price for this contract start dropping. And as you can see, it went into positive territory for me big time. So at this point, I saw no point of keeping the contract open. So I went ahead on May 13 and closed this contract for $59. So long story short, I have received $400, and then I closed it for $59. I could have waited for another month to expire, but I needed this cash to use it in a different strategy that will generate much more return. So this is a live example that I went through, and it was successful as long as you take a big time frame. So for me, this was 4 months, and as you can see, it did went against me for the most of the time. But you only needed to go in your direction for one time, and if you take that opportunity and just close the option, then you're in good shape. Okay guys, let's take another example with Tesla. So here you can see Tesla stocks is 174.5. Let's go to the trade Tesla options. We're going to change it to the put again. We're going to change it to the sell so we don't make any mistakes. And then from here, we're going to change it also to a few months. So In this example, we're going to take 3 months, similar to what we did with Apple. So if we go to 165, which is roughly $10 under where the current price is, meaning it will have to go down 11.81 for us to break even. So in this case, if we wanted to sell this, as you can see, we are getting $11.10 as a per share as a premium, which is really great. It's a big jump compared to Apple. The biggest difference and the reason for that is the implied volatility. The IV is very high compared to Apple. So if we want to see like percentage wise, so this is 11 divided on the price of the stock minus the 11, which in this case is going to be 154. That means we are getting 7% return, 7.15 return on our money for 3 months. So if we divided this on 3 months, in this case, we are getting 2.38 return on our money per month for the next 3 months. So same as with Apple, if the stock went down under 165, then we will have to buy for 165. If the stock ended at 165 or above, the option will expire out of the money and we just will be able to sell a new put. If the stocks ended above 165, then the contract will expire out of the money and we will be just able to use the same money to sell a new put at a later date, another 3 months, and collect more premium again. So that's really a great way to play an option that you don't mind buying, or like you want to buy but at a lower price while collecting the premium. If you get assigned in 3 months and you bought it for 165, in reality your cost will be the 165 minus the 11. So in reality your cost will be 154. And then after that, you can sell a new call on it. And that basically is called the wheel strategy. And we'll talk about it in a future videos. Looking at the other strike prices, there's 170, there's 175, there's 160, 155, 150. As you can see, there is different premium for each strike price. Basically, it goes up the more risk you are taking, and it goes down the lower risk you are taking, because if you are buying or you're offering an insurance to buy for 150, you are not buying for 165, you're buying for 150. That's $15 lower per share. So of course the premium you will collect, instead of 11, it will be 6. If you want to know what's the percentage the 6 make, we'll go here, we'll divide it. So 6 divided on 154 multiplied by 100, that is 4% in the 3 months. You divide it on 3, that's 1.38. So it's a lower return, but it's much safer bet than selling the 165. The stock, as you can see here, it will have to go 17.5 for you to break even. That is wonderful. That is wonderful cushion that you have right there. And in this case, if you say the 150 minus the 6, your cost average will be 144. Again, much lower than the 154 we talked about it before. I hope you found this helpful. I will add more videos to explain in depth more about how you can maximize your return with the put strategy, selling puts, and if you get assigned, then selling calls. And there is another way you can do rollover. In case you didn't want to hold that stock, you can roll over that puts, and we'll talk about it. You can only do it if it was slightly in the money. If it was way too deep in the money, of course you won't be able to do it, and unless you pushed it like for a year or more, which you might not want to do that. We'll discuss that in future video. The information provided in this video is for educational purpose only and should not be construed as a financial advice. Investing involves risk, and viewers should conduct their own research or consult a qualified financial advisor before making any investment decision. Thank you guys. If you like this video, please consider giving a thumbs up and subscribe to my channel. I will continue with educational videos about stock and option, and I will discuss my own experience as well. Thank you guys and have a wonderful day.